Today's February the 9th, 2017, and we're going to talk about one of my favorite buy signals, an ascending bullish wedge. I also want to point out that sometimes a short squeeze will create a situation that is transparent to a lot of professional traders. I'll get to that in a minute. But let's talk about threshold pharmaceuticals, call letters THLD. It's a penny stock sitting right now at around 60 cents. Now, an ascending bullish wedge, let's have a look at a little bit closer, is actually has resistance at around the same level, around 58 cents. Price keeps coming up and hitting a wall and stopping and going back down again. But the lows keep getting higher and higher, and the lows keep getting higher and higher and higher, creating a wedge. Now the objective is to catch this right at the end of the wedge, and where it turns from a basic consolidation and a tightening trading range into a pretty sharp uptrend. And it bursts out of this wedge, and that's where you make a lot of money. You can do a pre-buy and buy when it's in this range, or you can buy when it breaks out. Now, either way, if you decide to buy at this range, beware that way back here, give me back 3 months, way back here in this range where it was peaking, a lot of professional traders decided to short this stock. And in shorting the stock, you make money when the price goes down. Basically, in layman's terms, when you short a stock, you borrow the stock from your broker, you sell it high, put that money in an account on the premise that you will return the stock. Okay? So you get that money in your account, now you own the stock and you buy back at a lower price, and the difference between the two gives you a profit. Okay, so short sellers have got in because they've seen this starting to top, and they're selling. They've sold their long positions, and now they're starting to short stock, and it goes down here. Now the question is, where's it going to bottom? And short sellers, like everybody, are a little greedy. So what happens here is they hang on to their short position until they realize, ooh, this is not going to drop off. There's a chance it's going to go up this way. So I better buy the stock now and pay back my broker. What happens when a whole bunch of short sellers close their position, when they close their position, it's the opposite of selling. They have to go out and buy stocks off the market and pay their broker. So what it does, it creates demand, and it drives the stock price up out of this wedge. Okay? Now what happens to a whole bunch of guys like me and you and everybody who have placed orders, right? Your order gets executed, and it starts up in this direction, and a lot of profit takers turn around, bring it down into this area, and they drive the stock right back down again. So very often what happens is the short sellers will create a demand when they close their position, driving the stock price up here. And then, of course, you and I, we bought stocks, and we have a really tight stop loss, and the price quickly comes back down and takes us out of the trade. Happens. Sound familiar? It happens all the time. So an important thing to note about these wedges is that often there's a false start. Sometimes the price goes up, breaks through, and comes down actually below the support line here. Don't panic. Keep your eye on volume. And if volume is steady, then what happens more often than not, it comes down below the wedge, and then it takes off and is gone for 2 or 3 months in an uptrend. I'm Dave Gordon. Thanks for listening.